as we say in French, ce sont les aléas du direct. So this is really the age where, digital infrastructure, we're all prisoners or reliant on digital infrastructure. So Gail may be joining us, but without further ado, we'll start right away with that session for which you guys have complete carte blanche, to use another French word. So the general sort of overall title or theme is investment governance, ethos, and the social responsibility of business. The title is a wink to an early 70s economic theory book that was published, I think it was in Boston. And in the early 70s, the School of Chicago hadn't come to power yet. Reagan and Thatcher had not been elected yet. I'm saying this is a wink to David Weeks, but their ideas were already rising. So, the center left or the Keynesian were still in power in most of the world, but these neoliberal open markets, open border ideas were rising. And one of the early replies to Milton Friedman was that book, Ethos and the Social Responsibility of Business, which is saying maybe it's efficient to be a neoliberal, fair, but be careful, because it's one thing where it could be dangerous if it goes unchecked. It is the environment and social issues, because we can't just dump pollutants in the river or the ocean. Corporations, if they do so, need to pay a price. It is not a free ride. So that was the wink in that title for nerds like, I guess, Konstantinos and myself. But without further ado, since Gail may not be able to join us today, we shall perhaps start with Olivier Rousseau of FRR, the Fonds des Réserves pour les Retraites. So if you could give us, Olivier, your personal opening remarks before we move into a more interactive stage, but opening remarks or opening ideas around, investment governance and why it's important.
Thank you, Nick. Well, it's tricky to kind of start to outline the domains that we could cover because it is so broadly defined. I will immediately make a distinction between what I think is the role of an investor and what is the role of a company more generally. Let me be clear on the company's role. And I'm speaking in person, of course, I'm not speaking in the name of my institution. I am a bit surprised by all the fuss about companies that should suddenly have a beautiful purpose, being nice to everybody, saving the world, and so on. I have a much narrower definition of the corporate purpose. A corporation, a company's role is to produce goods and services. That's it. Then there are issues of how you do it. Do you do it decently, yes or no? And this has a lot to do with the changes in cultures, in corporate cultures, in ideology that we have experienced over the last 60 or 70 years. Take the US. In the 1950s, the CEOs were paid nicely, but nothing extraordinary. The companies were, by and large, taking care of the interests of all the constituencies. It changed. Today, Friedman won, and it's only about making profit. The rest is for the public sphere. We are sometimes very unfair to Friedman because, as you hinted at, externalities, Nick, Friedman, he said his framework is not to operate without regard to externalities, but externalities, the price on them has to be put by the public authorities, and they don't always do it. Today, we have the extremes to be represented on corporate purpose by the greedy American culture and the somewhat late Japanese corporate culture. The greedy Americans, they say, well, get the price for your products as high as the F customer will pay. In Japan, you have still a large tradition of engineers producing goods that they think are excellent technically, sometimes without much consideration for what the customers want, and sometimes not even being able to price the goods properly. This is changing actually, and probably what we want on the corporate side is people to meet halfway. The old Japanese culture is not reasonable, and the greedy American culture should come back to the American culture of a few decades ago. Now the investor's role is not to save the world, not for the corporate, not for the investor. That's my opinion. But the investor needs to be decent just as much as we want the corporate to be decent. That is, when you invest, there are things that you just don't want to consider, even if they mean potential diminished returns. You don't invest in companies producing landmines, for example, disregarding the existence of an international treaty or not. But if you want to push the let's do the good to the extreme as an investor, you will only have an impact investment portfolio. I'm not sure this is ideal. I know it is at odds with a lot of the current thinking, but the role of the investor is to produce good returns within the risk parameters and the other constraints for the realization of these investments. It is not to save the world. You have to be decent, but transforming an investor into an endowment or a foundation, this is another step. I'll stop there.
Very good point, because I think I'm aligned with you mostly on what you just said. To use a French word with some very minor nuances, but I'm aligned with you because, most of us here today, and I'm speaking very modestly, we're early believers in the SDGs and ESG long before it became fashionable. I'm including, of course, David Weeks, who published the Red Book 11 years ago. Of course, Nick Silver, if you're still around, we'd love to have you as questioner, who's the co-inventor of climate bonds 11, 12 years ago. So, all of us, we're early adopters. So we're not saying this from an ultra neoliberal, union carbide, polluting, evil, whatever. We're saying this, to use another French word, in a critique way, but a positive critique. So I think the note of caution that Olivier just raised is we shouldn't be moving from one extreme to the other. We as society or voters or investors, so not moving from 11, 12 years ago, carelessness and neglect and considering that tree hugging was a minuscule market niche and that ESG funds should represent 0.1% of the assets and only endowments and Al Gore and his sister should care about ESG. So that was one extreme 12, 13, 15 years ago. And now, in the past 12 months, it has been an avalanche of holier than you and greener than you, and everyone and their sister now pretends to be progressive and etc. and to love trees and hug them, etc. and to be socially advanced. So it has almost become, I was reading, the financial press. I was doing a little statistical game or exercise earlier this week. I was flipping on the front page of the main financial journals in 8 or 9 European countries, including Britain, on Monday and Tuesday. And practically all of them had on the front page climate finance, ESG, green assets. So it has become more than mainstream. It has become, omnipresent. And so that, to us, critical thinkers, should also raise a red flag, a small red flag, and say maybe there's too much talk and not enough action. And when there is action, it should not submerge the rest. So it should not completely change the purpose of the corporation, which is still, of course, to make money for shareholders. That should not change. It should, enhance it, improve it, make it better. But it's certainly not, the aim here is not to transform every corporation listed on the S&P 100 or the FTSE or the Bourse de Paris. The aim is not to transform them in some kinds of endowment or Mother Teresa institutions, they have to remain capitalist, but hopefully integrate and include ESG metrics within their broader money-making purpose. And I'll use it as a transition to go to Parma, Italy, to Konstantinos Sergakis to have his opening remarks. Konstantinos, the floor is yours.
Thank you, Nick, and delighted to share the floor again with all of you, and also with David Weeks, whose work within the AMNT and of course outside the MNT has been objectively legendary. I'm sure you will all agree with me. Let me start with a very, very simple observation. I myself am mainstream, as Nick knows, in the sense that, of course, we cannot expect from companies or investors to become foundations or pursuing goals that have nothing to do with their business. Nevertheless, the incorporation of SDGs and ESG, which of course has become a fashion as well in the last couple of years, is inevitable because now it has moved to the mainstream. So I'm wondering, could we find a solution right in the middle which says, let's all acknowledge that that's not our priority, but since it has now become a fashion, I'm not now judging whether this is a good or a bad thing. We will discuss it later. These are just opening remarks. So if this is now the new normal and if everyone is trying to fit in, how can we convince all these players to use ESG without misplacing their focus on what they have been doing so far all these years? So without radically changing the way you work and you interact with other market actors, whether you're a company or an investor, but trying, as Nick, you just mentioned, to incorporate some of these factors in order to see if you can have auxiliary ramifications into the whole system, which may be beneficial, but of course, under the condition that they also make sense in financial terms. Now, if you're a company, as I mentioned recently at an event in Belgium with the listed companies annual day from organized from Guberna and the Belgian Confederation of Enterprises, I think that a more realistic way to tackle these issues is not to keep on pushing for more stakeholder presence at all costs and shifting the corporate purpose to something else, something exogenous to what we have been accustomed to all these years and decades. And of course, I do agree with Milton Friedman to a certain extent, because of course, Milton Friedman was referring to the role of public authorities, which objectively lacks today in that kind of framework. And I'm sure Olivier will agree with me. So the question is that why are we shifting now the focus on investors? Exactly because we know that public authorities do not play the role that Milton Friedman was thinking about them playing in the future. So if we now have the investors to save us from all the les mots du capitalisme, in order to change in French for a second, with your permission, we now have to be also realistic. So what I proposed in that event in Belgium back in September was let companies keep on interacting with their stakeholders, but in a soft way, which means let's start having more advisory panels with various stakeholders, but with no binding force. Let's have advisory votes from stakeholders organized in an electronic fashion, again, with no binding force, just in order to keep on getting the vibes from the investor community and from, of course, stakeholders, in order to create this kind of more prolific interaction between various actors. But do not go and force companies to change their purpose. Of course, we now have in French law entreprise à mission, which was a new addition to the French legal framework a couple of years ago. And in Belgium as well, they have, to a certain extent, adopted some of these solutions in the Belgian Corporate Governance Code. And some companies do go there, but they do it voluntarily. And they do it because they are ready to do it, not because they are forced by hard law to go down that way. Now, if we now move to the investors and we talk about investment governance, since we have David Weeks in our panel, now, what I feel is lacking, and again, exactly because public authorities have not stepped in all these decades in order to dictate certain behavioral patterns or operational mantra in the investment chain, is that asset owners still do not have this kind of sense of ownership in relation to how they can influence, even in purely financial terms, on behalf of their beneficiaries, the investment world. Why do I say this? Because, of course, as Baroness Altman mentioned yesterday, we as beneficial owners, pension savers, we do not have ownership of what we, intellectually and psychologically speaking, of course, we do not have this kind of sense of ownership because everything has been disconnected. The investment chain is very, very, very long. So the problem also lies with asset owners because they do delegate via mandate to asset managers, if that's of course their case and their profile as asset owners, the management of the assets, and then the whole story gets lost. And why do I say this? Because from what I see and from what I also keep on doing, also Nick remembers that I have now been appointed to MEFOP as advisor, the Italian Ministry of Finance and Economy organization, which helps pension funds in Italy to be educated and prepared to perform their role accordingly. What we see now is that we have three problems. Pension funds struggle with exit, engagement, and voting practices when these deviate from what they think their asset manager should be doing. So they start with a mandate. And I have to say a mandate that they have not always prepared themselves in a sophisticated way in order to choose their asset manager. They rely primarily upon what the asset managers show to them. Then they start with a mandate, and then they see that in some cases, in engagement, voting, or exit aspects, things deviate. And then they are stuck, and they do not know how to react because they do not want to challenge the asset manager. They do not know how to monitor the asset manager, and then the communication is lost. So what we have been trying to do now with MEFOP since a couple of months is we have created guidelines for pension funds in order to use the comply or explain obligations that they have in terms of stewardship, in order to explain their engagement policy. And I have to say that pension funds react very, very positively to this kind of work because we are trying in a soft, gradually escalating way to convince them that they have to prepare themselves their own criteria and their own engagement priorities in order to choose the asset managers, and then we nudge them to keep on monitoring them. I also would like to share a little scoop for our forum. MEFOP is also taking very, very seriously and thinking seriously about creating its own stewardship code in 2021 for Italian pension funds. This is not has not been the case so far. We do not know yet if it's going to be a code or a set of principles or a set of guidelines, but it's I will be able to share more with you about the final form of this new soft law instrument in our next conference, Nick, in March 2021, which shows that organizations do understand the fact that we need soft law as well in order to keep on convincing pension funds to do better. Now, talking about this, and since we have the pleasure and the honor to have David Wicks in our panel, I'm sure that, and Nick alluded to it yesterday, very, very briefly, the pensions minister in the UK, Guy Opperman, also launched the task force on pension scheme voting implementation in the UK a couple of weeks ago, based on an AMNT report, which was entitled Bringing Shareholder Voting into the 21st Century, where we saw that the MNT actually raised concerns about the same issues, pension funds not being able to exercise their investment governance features because they are stuck in the middle between beneficiaries that they want what they want, and of course they are entitled to do so, and asset managers who keep on running faster and with much more sophisticated, many more sophisticated tools, and asset owners being stuck in the middle. So I do expect from this task force to come up with concrete solutions on how we can enable pension funds to influence asset managers, especially in the area of pooled funds, where we see that basically your mandate as an asset owner is lost. And Nick, just 2 minutes more, and then the floor is yours. I do expect from that task force to come up with solutions, because what we need to do in order to convince asset owners and asset managers, of course, to perform investment governance in the way we want it to be. And again, we go back to Olivier's point, maybe we are asking too much, but even if we go back to Olivier's point about being decent as an investor, I'm afraid, Olivier, that even to some of them, being decent does not make sense, because they are not even ready to understand what decency means within the investment chain, because they want to do a little bit more while remaining with their traditional financial return mission, but they still struggle to understand how they can perform that role. So that's what we need. We need better communication. We need, like the MEFOP initiatives, and not just because, of course, I'm part of MEFOP right now, but we need more gradually escalating, nudging initiatives. We need the task force in the UK, which will bring us more and more proposals in order to connect the dots. That's what we need in order to make it work. And of course, I leave back the floor to Nick, and we can have a more general discussion about these issues. Thank you.
Thank you, Konstantinos. It was great, and I think you opened some avenues that we shall explore further with David Weeks, of course, in London, Olivier, and Nick Silver. But without further ado, I'm aware of time, so we're now switching back to Amsterdam, the Netherlands. And I'm going to ask Joe Zammit-Lucia to get a little closer to the screen if he can.
Can't.
Just a little bit closer. Okay, if you had, then it's perfect. And of course, you know, Joe is the co-founder of the Radix think tank, which is one of the leading centrist think tanks in Britain and Europe. And what's great about Radix, and I think Nick Silver here is also a board member, is that it's a radical centrist. So they've used that early 60s John Kennedy metaphor, which I really like, because it means that if you're a centrist or if you're moderate, it doesn't mean that you have to be, as we say in French, mellow or mou or too soft. So you can be centrist, but at the same time, you know, be opinionated and strong. So I like that radical centrist, and I like the use of the Latin Roman root, which is a wordplay, of course, because radix has 3 meanings in Latin. But I'm sure Joe knows more than me because he is Italo-Maltese and he's also British, and he lives in Benelux. But to end my introduction, I think you know, today everyone and their sister speaks about biotech and fintech, and we live in the post-COVID era. So, you know, biotech and fintech have become really very fashionable. But, you know, Joe himself is a physician. He's a doctor. He was trained in biology early on, and he founded his own fintech biotech company a long time ago. So he has that experience, you know, how to use digital data and communication to enhance the knowledge, you know, of doctors, practitioners, and medical researchers. But it's not the reason why he's here today, but I think it would inform his worldview about finance, because perhaps finance is in need of a cure. Joe, if you'll allow that easy metaphor, the floor is yours.
Thank you. I wish the cure was as easy as injecting a vaccine for the finance world. But thank you, Nick, and thank you everybody for interesting discussions that we've had over 3 days, which I learned a lot. I'd like to say that I'm going to disagree with what has been said until now in this session, apart from some of the stuff that Konstantinos has said. I want to start with a little story from my years in the pharmaceutical business, when we were in a meeting with commercial and R&D people, and the R&D people were presenting their scientific ideas for future drug development. And one of the commercial people got bored halfway through the presentation and piped up and said, "This is all very interesting, but you guys seem to have forgotten that our job here is to make money." And the president of R&D piped up and said, he was a wise old Scotsman, and said, "Laddie, our job here is not to make money. Our job here is to make medicines that make people better. And if we can do that well, then we can make money." And this, in my view, is one of the perversions of current corporate thinking. There was a time when corporations had common sense, that their job was to provide useful products and services profitably, and to do so without causing damage. But that seems to have gone out the window, and people seem to believe that making money is the objective. The second thing I'd like to comment on is the comment that public authorities are not fulfilling their job. That may be true, but it's simplistic. Public authorities are under huge lobbying pressures by corporations. It's not that public authorities do not want to start including externalities in public policy, but there are billions of dollars flowing from corporations to stop that. Which brings me to the third point, to some of Olivier's comments, where he said, this is the job of investors, this is the job of managers, this is the job of public policy. And in my view, that takes us into what is called the fallacy of composition, which is that if everybody in their own silo does their job, then the system will work. And we know that that is not true because everything is interconnected. So the issue here, and you know, people have said, whether it's right or wrong, that just before the great financial crash, everybody was actually doing their job pretty well. The trouble is the system collapsed because of the interconnections. So this idea of this is the job of investors and they should focus on that, this is the job of managers and they should focus on that, that is a fundamentally flawed way of looking at things. Basically, we need to take a systems view. And I'd like to say a few things about the systems view. Until now, we've built the system view on the Anglo-Saxon model of capital markets and public quoted limited liability private corporations. And the narrative was a simple one, that shareholders and investors keep management from making off with the money while generating good returns from investors. The trouble is that what we have, that model is breaking down for many reasons, as we've heard a little bit earlier from the BlackRock representative. Businesses today need less capital for investment. Stock markets, you know, stock markets no longer make their money by intermediating the provision of capital. They now make most of their money by selling data. The shareholder model of the joint stock corporation has resulted in tremendous industrial development, but over time in frankly disastrous social, environmental, and let's not forget political consequences. We also need to accept that financial markets have morphed from providing the lifeblood on which industry is built to essentially becoming extractive systems that take money out of the real economy rather than putting it in. And the equity problems caused by our 20th century model of globalization have come back to bite us. So this, I think, raises some fundamental systemic questions. Where I agree with what has been said is that putting ESG plasters on the current system is not going to get us very far. In other words, it's no good saying we need to keep doing exactly the same stuff in the same way, but we should be a little bit nicer about it, which is essentially what people are saying. That companies should now have purpose, that we should ensure more transparency, that corporate governance somehow should make a little bit more of a nod to other stakeholders, that business should be doing exactly the same as they've always done, but let's please do it in a slightly more socially responsible way. But I think that the narrative should actually be a different one, because we're seeing a wholesale change, in my view, in capital markets. The balance of private versus public capital, the emergence of fundamentally different types of corporate structures with different incentives, pushed by COVID, but already before that, a huge increased interest in state involvement, from the resurgence of state-guided industrial strategy to re-exploration of the role of state-owned enterprises. And we also now understand that much shareholder value, so-called, is not in fact created, it is transferred. In other words, value is extracted out of our environment, out of depletion of natural capital, from our health and security through pollution and climate change, from social cohesion through tax arbitrage and continued downward pressure on wages, leading to increased inequalities, etc., etc. So what we're doing is not only creating shareholder value, but actually stealing it from one part of the system and putting it in another part of the system. And as a result of all this realizations, the absolute dominance of the Anglo-Saxon model of financial capitalization, which has been the benchmark for everything else, is, in my view, coming to an end. Of course, transformation is going to be slow. It'll be chaotic. There'll be many twists and turns with people pulling in opposite directions. And we're currently in the early stages. But the question, I think, is not whether we should do more ESG reporting, whether we should do, all that is a given. The question is what is the new model of political economy on which investors, businesses, and everybody else should base their business going forward? Because our current model of a political economy is actually running out of time. And pension funds are actually big enough to be significant drivers of such change. And we're already seeing some of these responses where some funds are starting to act as owners of businesses rather than investors, getting involved in day-to-day management and so forth. But business models take a long time to change, particularly so for risk-averse organizations. So I leave you with one question. Is the current ESG way of thinking simply about fixing a few of the faults of the current system? Or is it the early manifestation of the fact that the whole system is aging, no longer fit for purpose in the 21st century, and headed for systemic change? And can big investors and pension funds be the catalyst of such change? Or will they drag their heels and believe they should be putting plasters on the existing system? What can they do to make the very structure, the systemic structure of our financial system, once more do what it is supposed to do, which is to truly create widely distributed wealth through socially valuable industrial development? Thank you.
Thank you, Joe. And I think the questions is addressed to Olivier Rousseau and David Weeks and Nick Silver. I forgot to mention one of Nick Silver's many hats. He's a managing director of Calland in London, which is a boutique, famous actually, actuarial science pension advisory company advising inter alia public pension funds and sovereign funds, including in the developing world. So I think the question from Joe is addressed to Nick, to David Weeks and Olivier Rousseau. David, I'm going to ask you to recline a little bit downward the screen. I think you're using an iPad. If you could recline your screen downward, because we're losing the bottom 20% of your face. So if you could, recline it. Yeah, perfect. Very good. That was much better. Perfecto. And so that question from Joe is addressed to Olivier, Nick, and David. I'm going to say once again that all of us today are expressing our personal views and opinions. So it's an individual, personal perspective. So for example, Konstantinos is not speaking in the name of MEFOP or the Italian Ministry of Finance. Likewise, of course, Olivier Rousseau is with us today as an expert, as a free-thinking expert, not in the name of FRR or of the Georgia government Sovereign Wealth Fund, which he co-chairs. So it's all personal views, and that's why we're taking the liberty to speak here freely without handing the floor in that order, first to David Weeks, then to Olivier Rousseau, and then last but not least to Nick Silver. I want to make a quick comment because I think that's a great point that Joe made, and I'm glad we don't agree on everything because it would be boring and we could all be replaced by drones or robots. And I'm going to make another aparté today. I think the other Olivier Charousset informs me that we're roughly 115-ish now. I think we're 30 on Zoom, and Zoom is used mostly as a video production platform. So roughly 30 on Zoom, another 40-ish on Facebook and YouTube, with a 20-second feed time lag. And I think we had higher than expected radio, audio-only tuners. So we have like 40 or 45 people on radio only. And so Olivier in Brittany is filtering the questions coming from our listeners on audio and sending us back to our mini studio in Paris. So once again, for those who are only hearing us and not watching us with our beautiful suits and ties today, they will see us in early January when we release that short video of today's session. But without further ado, the only comment I want to make about Joe's remark, of course, corporations are not angels or business angels, and they do lobbying. And I'm saying this to David, you know, lobbying has always existed, of course, but you know what has changed in the past 30 or 35 years, or call it, you know, advocacy or whatever. So, corporate advocacy in Washington, D.C., and London and Paris, it has always existed, you know, since the time of the Roman Empire, if you read, you know, Roman history. But what may have changed in the past 30 or 25 years is the amount of money and energy devoted by increasingly large, gigantic corporations to advocacy and lobbying. And that happens at a time when the relative size of governments, the relative size, you know, the governments, the state's balance sheet is shrinking, and the relative size of some of these huge tech companies, or just any companies which are, you know, blue chips, look at their turnover or net profits. They're very much, you know, very often bigger than many countries in Asia or Africa or Eastern Europe, their annual turnover. So the balance of power may have shifted, and it may have given them more money to do more of what they have always done since times immemorial. And sometimes, you know, thinkers and academics, the good ones, are ahead of the curve. And so we spoke about Milton Friedman. There was another guy who was really brilliant in Chicago, but he spent less time in Chicago than Friedman. He moved around Iowa, New York, and Virginia, and his name is George Stigler. I invite our viewers to read the articles he wrote in the late 1950s. It's amazing because they were published in the late 1950s, and they sound like they were published last week or last month, because he predicted rightly, and it's really fantastic, that in the future, in the 21st century, two things would drive the world economy: information and data. And remember, in the 50s, computers were exotic machines. So he prophesied, like Marshall McLuhan, that deep data, information would transform the whole economy. And he also predicted that as company would grow bigger and bigger, they would try to capture the government itself. And I think he uses the word capture, and it's very true. And I think, you know, what he wrote in the late 50s, today, 70 years later, we are witnessing it in real time. We live in the age of the economics of information, or the finance of information, and we live in the age of huge mega advocacy and lobbying, not only by pharma companies, but by all companies. If you look at the CVs of the upcoming Biden administration, I think, you know, 2/3 of the future ministers or members of the Biden White House who will come to power in 7 weeks, 2/3 of them lived in the San Francisco Bay Area or Seattle area. That says a lot. It says that, you know, that the tech industry has a huge influence on government. It's also true in England or Europe. It's a fact. We need to adjust to that and maybe change things to try to avoid any, as we say in French, dérapage, or any exaggerated pressure from the private sector upon the public sector, and the revolving doors, you know, les portes tournantes. But so that was my, you know, my whatever personal rants. I will now hand the floor to my compatriot Olivier Rousseau to reply, you know, to Joe's question about, you know, what pensions can do in essence.
Thank you, Nick. I thought you had mentioned that you would first have David speak, but I'm happy to intervene in the order that you think.
Well, actually, you're right. It shows you that I'm tired. I didn't have enough coffee, intravenous caffeine injection. So let's go to David in London first, and then Olivier, and then Nick Silver. David, the floor is yours.
You're on mute, David.
David is frozen.
Yeah.
Okay, you know what? Olivier, start.
Yeah,
You start, Olivier,
that's it.
and I will text him.
I think it's an interesting discussion. Too much consensus can be boring, and it's certainly not the case in this situation. I don't disagree with all of what Joe said, though there are many points on which I would differ. But if we think of the corporate's role, I think we largely say the same. I quote you, a corporate's role is providing goods and services profitably and without inflicting damaging externalities. That's it. That's what I said, by the way. I won't discuss the fallacy of composition because it might be a very long story. Briefly on the global financial crisis, it's actually, in my opinion, the result of several factors, but one of them is there was a massive deficiency in supervision. And part of it was ideological because many regulators thought the private sector could not do wrong. These guys were making 10 times the money we were making in the public sector, so they had to be 10 times better. That was the dominant paradigm of the time, and it was totally wrong. It was a fallacy, to take your words. Now, there are massive problems in not just our capitalist system, in our society. I would actually go much farther than you do, Joe. You say lobbying is a real problem. It's an enormous problem. It's fine that companies must explain to the public authorities the conditions in which they operate, because you want the civil servants and the politicians to make well-informed decisions. But of course, we know that lobbying is much more than that. And it's a portion that we don't necessarily like. But we have bigger problems in society. Advertising, it has massively grown over the decades. What is advertising? It is creating false needs among the people. It is creating a massive resentment because you see the lives of people able to buy stupidly priced watches and whatever, and you know you can't do it. This is not a problem of the economy as such. This is a problem of the society. And also a problem that we have, and it's massive, it's the rule by the medias. And it brings me back to one of the points I wanted to make after Konstantinos' remarks that I thought were very good also. But the fact that the media have become so powerful is a massive problem, because it means the governments do not dare to do their job. ESG, it's a religion today. Yes, the governments are promoting it. Have I said that it is not good? Absolutely not. I think actually ESG should have been something very old, just as old as financial analysis. If you invest in a stock, you do the financial analysis, good. But if you don't study the E, S, and G risks, you've done half of your job, because ESG will become the financial problems of the future. So it has always been something necessary for an investor, and it's not about doing good for the society, it's only doing your proper job for your role as an investor. And now my final point, the public authorities. My fear is today the governments are weak, they do not dare to do their job, they are absolutely frozen by the power of the media. Look at the COVID. We stop the societies and the economy. What? Because we don't want the TV cameras to be in hospital emergency wards showing people dying and not being taken care of because the hospital is overwhelmed. That is a big explanation behind the whole situation we have. And the public authorities, they identify the problems of the climate change and the environment and so on, absolutely, but they don't dare to take the regulatory steps, so they find it very convenient to pass the buck to investors and to the banks. And so we now have the banks and the investors that are supposed to do plenty of things which they don't have the means to do. if you don't put a price on carbon, that will not fly, simply because well-intending investors may divest or may influence corporates to become less carbon intensive. Yes, but the less well-intended people will buy the bad stuff from you. It will not change much. It will, because it makes capital more expensive for the bad guys, but that's not enough. Put a price on carbon. And this we can do as individuals, not as employees or managers of companies, not as managers of pension funds, but as civil citizens voting and expressing their unhappiness about governments not doing their job. This is my view. So I am much more radical than probably you thought initially when I spoke.
You're muted, Nick.
Nick, you're muted.
I'm trying to spare you of the construction site, but the workers have stopped their mechanical sledgehammers, so I'm going to remain unmuted for the remaining of the session. I was saying that David Weeks is on the way to relogging on his iPad, so we'll change one more time the order of passage. David, you're here. Okay, great. Can you hear us, David? We can see you.
Can you hear me? The link keeps cutting out visually and sound, so I'm a bit out of touch for the last 10 minutes or so. I don't know what's going on.
No worries. We can see you and hear you with a 5-second feed delay, so it's good. So since now it's
Can you hear me?
Yes. We can hear you and see you. Yeah. So there was a question to. Can you hear us?
I can hear you now, yes. As I say, for the last 10 minutes or so, it's been a bit fractured.
No worries. I'm going to recap basically Joe's question to you. And I think Konstantinos also earlier praised your work and the work that you spearheaded jointly with the pension minister, which yielded that beautiful, fruit, which is that task force on pension voting, which is currently being established as we speak in London. And there was also a question from Joe Zammit-Lucia addressed to you. What can pension board members, what can pension trustees do to steer more capital towards, more productive and ESG informed assets to make the world, a better place, etc. So, the whole notion of fiduciary capitalism, I think, what Joe alluded to. Mr. Chairman, Mr. Rapporteur, the floor is yours.
Yes, thank you very much, Nick. I hope that my connection will link. As you say, the Association of Member-Nominated Trustees has pursued an initiative which has the strong backing of the UK Pensions Minister, Guy Opperman, on the rights of asset owners as opposed to asset managers. Guy Opperman's view is that there are two things that we need to do if we're going to get pension investment up to the sort of level that we want them to do. Number one is to have instantly available information, perhaps through mobile phones, whatever, to the state of the pension fund, which members can look at. But the second one, and the more important one, I think, in his view, is that increasingly members of pension schemes, and in particular younger members of pension schemes, want to see that their money not only produces decent returns, but also produces or supports ends which are socially desirable. So that's the sort of background to it. How do we come to where we are in the discussion? I see that there are sort of generally 5 phases in these things. Number one is when the prophets, the John the Baptist and the wilderness, preach the cause and don't necessarily get a good good response. Number two is when the regulators and the officials support the cause, and that's where we are on asset ownership with pension schemes, I think. Now, phase number three, and this is where my members, my working trustees come in, is when the working trustees actually apply these truths which are becoming apparent, actually take root in the administration of large-scale pension scheme. So that's the third one. The fourth one, which we've skated on in various sessions in this conference, a data collection to establish what exactly is happening. One of the problems that we faced with the trustee initiative for asset owners was that data was badly available. Trust managers were reluctant to reply, presumably on the grounds that either A, it was inconvenient, or B, it took funds from their margin. So I think those need to be overcome. And then the final phase is when the lawyers start getting involved in the scene. At the moment, that hasn't happened. So 5 phases to do it, to implement what the Minister of Pensions supported. And I hope that in the UK, we shall see that the Minister's initiative in working with the AMNT, Association of Member Nominated Trustees, will produce a significant move forward in that direction. Overall, as you yourself have said in your recent remarks, which I did manage to hear, these issues are really related to balance of power issues. You asked how much there's a consensus towards this. I think we're gradually moving towards a consensus. Collectively, the management industry at the top end is probably firmly committed to these sort of changes. The lower slopes of the industry are probably not so committed. So I think that is probably the next serious step of work which we, the Association of Member Nominated Trustees and the Minister will want to work on to bring up the standard of the average and below average to the standard of the best. And high in the league, I would point to, I think, the work that BlackRock have done in terms of promoting these things. So you here have the top end of the trade. We represent the top end of trustees in terms of qualifications and expertise and commitment. And we hope that the rest of the industry will be able to come up in short order.
Thank you, Mr. Chairman, and thank you also for being the rapporteur, because of course, you know, not early January when we publish these short individual segments on LinkedIn and YouTube, they'll be accompanied by David Week's usual annual rapport or report, which is 15 or 20 pages long, which gives us the quintessence, the quintessence of our debates. It was a great session. Delighted to have you. I mean, we could go on for hours, and I think I will, I'm aware of time. So before we move to Dr. Muhammad Tariq, who is the former treasurer and CIO of the Islamic Development Bank. And I think some of you may want to stay on perhaps to ask questions at the end of a segment, but before that, you know, I would perhaps like to give, if he's still around, to give the last, you know, 2 minutes to Nick, basically, because I think you've worked with governments, including in emerging markets. And speaking of emerging markets, I think Olivier now has also a board role and a chairmanship role with that newly established Georgian sovereign wealth fund. So really, Eurasia or Euro-Asia stretches from Brest and Lannion, where from Brest or Lannion, where Olivier Charousset is based today in the studio, to Vladivostok, so from Brittany to Siberia, and so the Caucasian region is at the middle. But what I want to say is that, Nick, just 2 minutes to wrap up that conversation. You have advised governments, sovereign funds, and public pension funds the world over, including in emerging markets. You're an actuary. So you're a cold-blooded actuary, if I may say. So I guess figures and statistical constraints and asset liability management have to come first. But when you're talking to policymakers or pension investors, how do you convince them that it's great to be in balance and to have your asset liability matching, blah blah blah, actually? But how can you convince them that also incorporating ESG parameters is vital for them?
Okay, well, thank you very much for the floor. And I had wanted to ask Nick, but are the people who are making noise drilling, are they an infrastructure fund, a government fund, or a private sector investor? Anyway, I have to say, great disappointment that I entirely agree with Joe, because it's a great disappointment, but because I'm a co-trustee, a co-founder of Radix, and we normally disagree, and it looks like we're doing the same. And I want to use, rather than being actually, use a very French concept of deconstructionism. I don't know how you say that in French, because I got to. And I wanted to actually, apologies for this, Olivier, deconstruct what you said, because, well, and it goes down to this, fallacy of composition of what Joe mentioned. So I advise governments around the world and pension funds. Now, basically, no one wants to save as a pension. It's not a natural thing to do. So governments get people to save in their pensions. Like Olivier works for the Georgian government, so often they're not a private individual, right? And most of the big pension funds in the world are not private sector, but they're big government entities, or the Californian state pension fund, the California state teachers pension fund, the Japanese government, right? And the idea why governments do this is because they want investment into their economies, so that the wise private sector investment manage the resources of the country, so that the country's economy can grow sustainably, and we get an economy which can then pay back its pensions. And it doesn't actually matter if the funds are unfunded or funded, but you need the country to grow to be able to pay your pensioners. And then this is where you get to the fallacy of composition, where you have the private actors all maximizing risk return, right, may not necessarily end up where you get this sustainable economy. And there's a great cartoon which says, yeah, we destroyed the planet, but we had great years of maximizing shareholder value, right? And so this is where I get to the deconstruction of what Olivier said, who very kindly gave me a straw man to shoot down. And sorry, this is a bit of a straw man. So you said, well, it's all government's fault. The lobbying is a bit of a problem, but there are all these things like advertising, and I can't remember what else you said. And the financial crisis was caused by governments, the problem with regulators, right? But what is the underlying cause of this problem? Well, why do regulators bought the idea that it's great for people in the finance sector to make millions of pounds? Because it's what Gramsci called hegemony, right? And why is there a hegemony? Well, it's because big financial firms fund business schools to pump out this rubbish, right? And therefore, which is then captured by the radio. So I'm giving a slightly amusing. And then, so why do companies advertise? Well, why is there advertising? Why it's so dominant? Well, companies are trying to maximize return, short-term returns. And how do you do it? Well, you can, you spend a lot of money on advertising to persuade people to spend too much stuff that they don't need. And there's a great book by Angus Deaton and his wife, Anne Case, called The Deaths of Despair, something like in America. So it was, why have this populist movement in America suddenly sprung out and rated Trump? Well, he puts it all down to he notes that white people in USA states, their death rate, their life expectancy actually decreased, right? And the causal factor of this is the US healthcare system, effectively big pharma extracting rent from it, and it's a causal chain, right? So, but why do big pharma companies do that? Well, their shareholders, who are big pension funds, who are government entities, are telling them we need to maximize risk return. And so how they do it? Well, they lobby governments, and the governments, and lobby regulators to pay them too much for healthcare costs in America, and this leads to ultimately down the line when companies can't afford to employ people. So Nick's giving me the thumbs up. I don't know what I'm saying. So the causal factors, and you can't say it's all big business and all the investors' fault, but the system of like us saving our money via pensions. The pensions are supposed to steward companies, and they're not doing that, and this causes all of the dysfunctions which we radicals have all identified. You can't really strip them out. There are other causal factors, but you can't then say, well, I'm just an investor, so I'm looking at risk return. Yeah, you might be doing that, but actually it's the framework under which pension funds are operating is not correct. And I agree with Joe again. The ESG is another sticking plaster, right? It can't ever go far enough unless you meet that. But then just one last thing, ESG is also a way out of it, because the capital markets are all saying we're green, we're sustainable, right? And at some point there'll come a reckoning where, one, are you really? Or the markets are saying we want green, and the underlying investors, the millennials who are investing in that, will go, well, I'm paying you a lot of fees to, I don't just want risk return, I want this other thing, right? This other thing, which is, so, and you're not really doing that. So products will come up to solve this problem. So